In this video, I'm going to show you how to trade straddles and strangles in Robinhood. But first, we need to know the difference between a straddle and a strangle, which most of these are going to be strangles on Robinhood by using that icon. Our construction of a strangle is buying one out of the money call option and simultaneously buying one out of the money put option. And what that looks like is we'll just go down to this medium term high risk. It is $8 call, $4 put. So I'm just going to go back to, this is 7/19/19. So I'm going to go up top here. And I'm doing this just for educational purposes. Boom. And then what I'm going to do is I'm going to buy, here's my price. I'm going to buy that $4 put. So I'm going to go select and put, buy $4. And then I'm going to go over to call. And I'm still on buy. And I'm going to go to that $8. And then I'm going to go down to the options. And boom, there's my strangle for $85. That's how you set it up. So now we'll go back to the home page. We'll click on that icon again. I'm going to go show more. And that's setting up this guy right here. All right, so this is a fairly long strangle. And what it is it is a limited profit, limited risk strategy, and should only be taken when the options trader thinks that the underlying stock will experience significant volatility in the near future. Go up or down drastically. My rule of thumb is only start one of these trades when you're in the 70 to 100% of volatility. So now I'm going to show you another example of a strangle using XLI. And I'm just going to pick this long-term one right here. So I'm buying a 75 call, and then I'm simultaneously buying a 60 put. And currently the price is at $68.18. So what I'm going to do is I'm just going to click on this guy, and it'll give you your profit and loss statement here. And this is very important to understand. And so let me help you go through it so that we can figure it out together. So let's just start in the middle here. The max loss is $467. That's what I paid for the contract. So now at is obviously the current price of the underlying asset at $68.18. So the break even on the upside, the call side, is going to be what I paid for the contract, so $4.67 or $467 plus that 75. But in this case, I'm going to go 75 plus 467 is going to give me my break even of 79.67. Meaning that before expiration, I need my price to go from $68.18 up to $79.67 to make back what I paid on the contract, $467. And then anything above that, well, can literally be unlimited gain, meaning it could go to 1,000, it could go to 10,000, it could go to 1,000,000 theoretically. Chances are that's not going to happen, but this is theoretical. And then same thing on the bottom. To get my break-even price, I have to minus my put that I paid for, which was the 60, minus what I paid for the contract, the 467, to get my 55.33. And then anything below 55.33, well, I'm going to continue to make up until zero. So I've got the max profit of $5,533, meaning that my asset went to zero. That's why it's a max gain. And then anything in between my two break-even prices, I'm going to lose money at expiration. And last, if my price of my asset was to end at expiration at one of my strike prices, 75 on the upside, the call, or $60 on the put, well, I would have my max loss at that point. So I hope that makes sense, guys. I know that was fairly a 10,000 foot view, but that is a strangle. All right. If you need more help, leave me a comment below. I will try to get to you as soon as I can. I'm here to help you guys. All right. So now that we understand the strangle, let's go to the straddle. So I'm going to delete everything about the strangle. All right. So first, I'm going to go through with Robinhood. We're clicking on this guy right here. All right. And that's going to be our straddle and strangle indicator. Next one is iron condors. I've got a video on my channel if you guys want to check that out for there. But we're going to go back to this guy, straddle or strangle. I'm under the same XLI that we're going to play with. Unfortunately, this is fairly misleading because all of these are strangles. They're not straddles. All right. And why? Because as we just went over, strangles, two different prices. All right. 69 call, 67 put, 71 call, 66 put. If this was a straddle, these numbers would be the same. All right. It would be 69, 69, 71, 71. So before we go any further, if you want to do a straddle, well, you're going to have to pick an expiration date. And let me show you. Let's just keep things consistent with what we had before. I was in, was it July? Oh, let's go June. So I'm going to go June. All right. And my current price is $68.18. Well, if I want to do the straddle, I have to buy two exact at the money call and put options simultaneous. So what I'm going to do is I'm going to go select. I'm going to hit 69 on the buy for the call. Then I'm going to go put, still at buy, 69. And I'm going to go down here. All right. What does it say? Straddle. Boom. It's going to cost me $833. So, just review, pick that, and swipe. So now that we know how to set up a straddle, well, what actually is a straddle? Well, a straddle is a unlimited profit, limited risk option strategy that's only used by us option traders when we think the underlying asset, whatever stock we're choosing, our security, is going to experience significant volatility throughout our expiration, our contract period. And again, rule of thumb is only get into one of these contracts when your implied volatility is 70 to 100. Yes, you can have a little bit of wiggle room if it's around 65 or so. It's your judgment call, but typically you can make the most money, and these work the best when they're in that 70, 100 range. So we're almost done. Last thing we just need to go through is your profit and loss graph, what that looks like with a straddle. So the next thing we have to go through is the profit and loss statement, which looks a lot like the strangle. If you're going, hey, Johnny, they look almost identical. Well, they're pretty damn close. So what's different is your max loss is a little bit more, and that's because you had to buy two option contracts right at the money, not around the money. It was at the money. In this case, we bought a 69 call and a 69 put. So what that means is at expiration, if it doesn't move at all, it stays right where it's at the 68.18. Well, my max loss is going to be relatively close to that 833. And on the upside, my break even is going to be my max loss. Remember, guys, how we did this? It was 833 plus 69 gives us the 77.33. So up until the price goes to $77.33, I've just covered what it cost me for the contract. Everything above that, I'm good. It's all gravy, right? It's going to the moon. I've got unlimited profit potential. On the downside, it's the same. If you can tell me, what do you do? Correct. If you guys all said it's got to be 833 minus 69, $8.33 minus 69 gives me $60.67. That's going to be my break even on the downside. Well, avid subscribers how to do strangles and straddles in the Robinhood app. You guys have been awesome. I can't thank you enough for all the support you've been giving me. If you like what I'm doing, please hit a like there. And if you like even more what I'm doing, hit subscribe for me. I try to bring good content to you guys, stuff that I would want to learn, what I would want to watch every week. And I prefer strangles just because they're a little bit cheaper, but both of these strategies work if you think the market is going to be very volatile and you don't have a direction play where you don't think it's going to go up or down. You think it's just going to make a big move in one direction. So until next time, guys, this is Johnny. Good luck.